A milestone for the overhaul of the global tax system. 130 countries have backed plans for new rules to tax companies at a rate of at least 15% after 2 days of talks. This is to prevent multinational companies from booking profits in low-tax countries, regardless of where the money was made. The Organization for Economic Cooperation and Development, which hosted the talk, says a minimum corporate income tax of at least 15% could bring in about $150 billion in extra global tax revenues annually. The new system would also reallocate taxing rights over MNCs from their home countries to those where they operate and earn profits, even if they don't have a physical presence there. The deal will be finalized by October and takes effect in 2023. The 9 countries that did not sign the deal include low-tax EU members Ireland, Estonia, as well as Sri Lanka and Kenya. Well, to share his insights on the possible implications on Singapore, we're joined by Chris Wu, tax leader from PwC Singapore. Well, Chris, how would these changes impact Singapore's ability to attract investments?
Thanks for having me, Liz. Well, the changes are definitely going to be impacting our current corporate tax incentive regime. As you know, the incentive regime is there to help us to level the playing field in terms of lowering the cost of business in Singapore. Given that Singapore may have certain areas where, for example, land and labor, which is higher. So with this global minimum tax rate, it effectively takes away that advantage for certain companies which are in Singapore and from countries which are going to be signing up to this global minimum corporate tax rate.
And Chris, like for the MNCs that are already established here, how are they going to be affected?
Well, the MNCs that are already here obviously won't be impacted immediately, given it's going to be rolled out in 2023. But certainly with impending changes, many MNCs, even our clients at PwC, are already considering and thinking about what is the real impact going to be to their overall cost of doing business, and are there alternatives which are available. So definitely, it is something we need to start thinking about in terms of broadening the ideas of continuing to make Singapore attractive.
And which sectors are likely to be more affected by this new tax plan?
Well, all sectors are going to be impacted because it's a wide-ranging regime. But I am aware that certain sectors are seeking exemption. You may have read in terms of the financial services sector as a start, in terms of the UK taking the lead of exempting it. And also another sector possibly which might be exempted is the shipping sector. But overall, most sectors will be impacted by this new regime.
You know, these technical details are agreed in spirit, but what challenges remain in having a deal in place in 2 years, which, of course, is the target?
Certainly, in terms of the devil's going to be in the details of how they actually calculate that effective tax rate of 15%. What are the incomes? How's the income going to be determined, which is going to be included in there? What are the various expenses which are going to be allowed as a deduction to calculate ultimately the profit, which is going to be subject to this tax? So it is going to be something we need to keep our eye on to see what OECD recommends in terms of that determination, and then what the various countries are going to do in terms of reacting to such recommendations.
And Chris, with the playing field leveled, where do you see Singapore adding value beyond factors like political stability and financing?
Well, Singapore still has many advantages, as you probably have seen from the latest competitive analysis. Singapore may have dipped, but it's still the highest in Asia. Well, I think Singapore needs to focus on new areas in terms of economic growth, such as areas around the sustainability move. Definitely, we need to increase the level of our skills, the skills of our workforce. That's certainly very key. And we need to continue to building on infrastructure that includes allowing Singapore, for example, to have a lower carbon footprint, because that's going to be something which is also going to be a big focus on. And last but not least, perhaps Singapore should also start to look at alternative incentives other than the taxes, building on that it already has, but building on its alternative incentives to, like I said, continue to make Singapore attractive where it perhaps may be at a higher cost or be seen as a disadvantage. And I think it's working with the business community, which is going to be pretty important in the next few years.
Oh, thanks very much for that. Chris Wu, tax leader from PwC Singapore.